Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good afternoon and good evening. Welcome to Traders Workshop for Tuesday, June 27th. I'll be your host, Tom Schneider, CMT with NinjaTrader, and it's my pleasure, my honor to have back the founder of SpotGamma. We're going to be talking about options, founder of SpotGamma. Who else would we do it with but Brent Kochuba? Brent, how you doing today?
I'm doing really well. Thank you for having me again. Love talking to you guys.
Yeah, no, it's great to have you back on. And I know, I was off last week and I heard you were off last week. So where did you go for vacation? I just want to hear more about that because I love vacation stories.
I go to Martha's Vineyard every year. I hang out with Barack Obama and, shoot the stuff. But I like going out there. They have a nice drive-on beach. That's my big thing. You can take your truck out on the beach. So that's why I like to go there every year. And my wife's not big into that, but she suffers through it.
So explain that to me, because I grew up going to different kinds of beaches, right? Where you didn't have drive-on beaches. So what does that mean? You drive onto the beach and you can barbecue? Is it like tailgating? Is it like setting up your space? Is that what it is?
Yeah, you got, so I have a pickup truck, and so I throw the kids and all their beach toys and snacks and all that kind of stuff. If you're a dad, you know what that's like. You got to hump all that stuff around. So in this case, you just throw it all in the truck, and then when you get out to the beach, you got to buy like a little pass, and then you drive out. They have a wildlife refuge out there, and I don't know how big it is. I think it's 30 or 40 acres, maybe a little bit longer. The loop you drive on is like 5 miles, so it's a lot of space. And so it's relatively less crowded out there because it's a little bit tough to get to. But it's great. It's the one kind of famous thing about it is that's where Bobby Kennedy drove the car into the water. You know that whole famous story from the 70s?
Oh, Ted Kennedy, right?
Ted Kennedy, sorry.
Ted Kennedy,
not Bobby Kennedy. Sorry, everybody.
Different Kennedy.
For that one. Different Kennedy.
Well, that's
Kennedy.
good.
Yeah, my bad. Slip of the tongue.
It sounds awesome to be able to do that.
It's great, yeah.
Just a little more autonomy that you have. But for those of our viewers who are new to Traders Workshop or might not have seen you before, can you give a little bit of background about what you do, how you got to this place, just so we know, where we're setting the frame for this show's discussion? Yeah,
thanks. So I've have about 20 years of institutional derivatives experience. I worked at a couple of banks, Credit Suisse and Bank of America. I then was a broker at Wolverine, which is an options market maker. So had a lot of options related experience there. After that, I went to a family office for a few years and worked for a portfolio manager who traded an S&P 500 options strategy. So through all that experience, I built various different models and built, I would say, kind of a framework to look at options markets. And that model and framework is sort of what SpotGamma is based on. And so what we do at SpotGamma is we analyze the S&P and the NASDAQ every single morning. We write a research note about that. We bring up interesting things that are happening in the options landscape. And we try to relay how the hedging around options flows may impact the underlying market. So the key idea is, like, if a lot of index options are trading the S&P 500 index, can that make futures go up or down? Those are the types of questions that we answer on a daily basis.
And that can also inform your clients as to what's happening in the equities market, right? Because of the ETFs, the spider ETF, that kind of thing.
That's 100% right. So, a big part of our user base trades futures only. They don't trade the options or equities at all, right? Obviously, you can use this information to trade Tesla and NVIDIA and things like that. But what we find is that a lot of times, if you're going to hedge, say, the S&P 500 index options and you're a big broker or a market maker, you're probably trading the future, right? You're probably trading that E-mini or the NASDAQ future or whatever it may be. And not only do you have that underlying hedging flow, we find that the way that the volatility, so let's say the VIX and VIX futures moves around, can also have an impact on the way that the underlying market behaves. And so you can see a lot of those kind of options market fingerprints in the price action of the futures markets. And I think a lot of times you may be sitting there thinking, hey, why did the futures just go up or down, 10 or 15 handles? I don't see news out there. What's going on? You can find answers to those questions oftentimes in options market flows.
Got it. I just keep coming back to the fact that you started this business right before COVID hit, right? Isn't that true?
Yeah, the family I worked for was a big family in real estate. That's where most of their investments were when COVID hit and the world shut down. They kind of closed everything. And so, I was sitting there in January of 2020, and that's when the lockdown was starting. So, I kind of said, well, let me put these models up online and just see what happens. And, it was fortuitous because the options market, volumes exploded and everybody was sitting at home day trading, and that led to a lot of these options, explosions, right? Tesla and meme mania and all these different things, and now we have zero DT options, and so I think luck is a large part of what takes place in life, and if you're prepared to take advantage of luck, then good things happen to you, and so. It was again fortuitous timing, and the growth of the options market certainly helped me in SpotGamma as a business.
You had a little, and I do want to get to the topic, but I think from a personal side, you had a little bit of a spot in a documentary. Am I correct about GameStop?
Yeah, so I was one of many GameStop documentaries that ended up coming out. Ours was produced by NBC. And you can still find it up there. It's called Diamond Hands, and it was a pretty interesting kind of an artful movie that they produced. And our kind of idea there, or I think kind of what the bent they took on the market was that like a lot of others, these retail traders were sort of radicalized and given money, and they wanted to stick it to the system. And I think it's a pretty interesting movie. Visually it's very interesting. They have some big names in there. That like Mike Novogratz, for example, that are in that documentary. I think another one just came out recently on the GameStop thing. It's actually kind of funny because the producer that put the thing together had actually tried to pitch the movie about 6 months or a year before GameStop happened. And NBC didn't want to do it. And had they done it, the timing just would have been, incredible to have that kind of a documentary behind the options explosions. Her idea was that Tesla was kind of like this meme stock squeeze. It was like the first meme stock. And I thought that was true. If you look a year before GameStop happened, it was Elon pumping the options market. And so, that was it was quite an interesting experience. My first kind of big screen experience, and don't know if that'll ever happen again.
Well, I asked because I was reminded. I took my son to a movie, and there was a preview for the movie, the actual theatrical release of another movie on the same topic, and I thought, oh, Brent might be involved in this, and I thought I'd ask him. But I know you were involved with the documentary.
Yeah,
probably about a year ago. Yeah, that's pretty cool.
Yeah, it wasn't in that one. I think the holy grail is, if you can get like George Clooney or somebody to play you in a movie, maybe that's a step better than appearing in a documentary. So George Clooney's a little older than me. I don't know who I'm more appropriate for.
Well, he certainly looks like you. I don't think it's the other way around.
Yeah, he's 15 years older than me, I think. I don't know. I'm getting older, but he's getting. Some of these actors, like the movie that just had Leonardo DiCaprio come out, I saw a picture of him in that movie, and you're like, what the heck? He looks like he's 100 years old.
Yeah, no, it happens, but we still say this. We still stay the same, right? We still look the same as we did when we were 20. I love it.
That's right.
So let's get into it. I think this is great. So the topic, I thought you came up with a very interesting topic because the topic being about call option volume and what it's telling us. And to me, it made me think. My limited knowledge is like, oh well, if there's call volume up, it's bullish. Market's bullish. But there must be some other piece to that, because that seems to me maybe not day one, maybe it's day two of options training 101. But I'm interested to hear what you have to say about that. Yeah.
So the market over the last, since we talked, certainly over the last month or 6 weeks or whatever it may be, it's been characterized by heavy doses of call buying. Such that on the 6th of June, we had record IWM volume, call volume. On the 15th, we had record SPX volume. It's all-time records. huge call volumes in all of the AI stocks. So, that idea of narrowing breadth, right, is one that we're all aware of, and AI mania and these kinds of things. And so what's happened is it's sort of created this, and this is unwinding a bit, but what it did is it created this kind of weird dislocation, or changed the correlations that we're used to. And the idea, the best way to frame that is the stock market's been going up and the VIX was going up, or what we say is implied volatility is going up at the same time. Which is really unusual. And what that speaks to is traders trying to buy call options and chasing the market higher, right? First it was AI names, and then we had this bout of IWM and small caps getting chased higher, right? And so, that's created this weird market up, vol up correlation. And as we usually know, what happens is like the VIX comes down, right, when the market goes up, and vice versa. But that correlation will last over the last 2-3 days, it's unwound a little bit, but certainly over last week, we had a positive correlation there, meaning VIX up, market up, which speaks to kind of a chasing mentality in the market, right? People making sure they're not getting left behind. And what's interesting about this is we had these record call volumes, again, IWM, which you're looking at in the S&P 500. But what we saw was on the 15th, as hopefully you can see on the screen here, this is OPEX day. This was the June quarterly options expiration. Again, record call volume on this day. That marked the top, at least in the short term, for the S&P 500. And in our view, the reason that happened is we had a massive amount of call options expire, right? Huge volumes of call options, both in single stocks, in the indexes, all that was wiped out. So any kind of options dealer hedging flows that corresponded to these big call option purchases, all those hedging flows get wiped out. And now we're seeing a reset, so to speak, or some consolidation, I would say, over these last 2 weeks.
Right. So we've noticed in the S&P and some stock index futures in general that there has been a bit of a pullback,
yep,
which we would call, it's not quite a 23% pullback when we're talking about the previous move, right? So we're not talking about price, we're talking about in terms of the last uptrend. We pulled back maybe 20% off of that peak. It's hard to see it here because I think you have a longer view, but point is that peak that happened in June, and June 15th, also did it correspond with an FOMC meeting or very close? Or
yeah, the FOMC was a couple days before, so the FOMC was right in here, and then we rallied, and this is literally options expiration is right here on the 16th, and that marked. What's so fascinating is if you look at the high of this day, and this is one of the reasons you got to be aware of the options market trading, and I'm still getting my kind of Bloomberg training here, but if we go back, I think 20 days, if you look at the actual opening high of OPEX day, so this day right here, the high of the market, the futures ramped, right, pre-market at 9:30 in the morning, all of the S&P AM options expire. That's a massive options expiration, and all of those options are struck to whatever the opening cash settlement price is, right, at 9:30 a.m. Eastern. So the futures ripped right at 9:30. The print happens, meaning all the options settle at that price, and then the market immediately sold off, right? That's literally what this peak is right here. And so if you're sitting there watching in the morning, you go like, why did futures just rally 10, 15, 20 handles? Market prints, all these options values are struck at that level, and then all of a sudden we sell off, and we kind of haven't looked back. The other thing in here is we had a VIX expiration where we lost about 1/3 of total VIX options positions, which I think kind of freed things up to move a little bit more. And so that's really been tied to this consolidation, I think, writ large.
And that volume too is, I won't say exaggerated, but it is larger because it is a quarterly month where there tends to be
100%.
larger positions on the June, December, September, March months.
That's exactly right. Yep. And so that's because the bigger institutions, they'll hedge for the quarter, they'll do whatever they need to do. They'll position on these quarterly expirations, and then they don't close those positions out, right? They'll roll them on the quarterly expiration. But generally, if you're like Bridgewater and you buy 100,000 puts to hedge your portfolio, you're not day trading those. Like the liquidity's not there. You're not moving them around. They're there for this reason. It's a sunk cost, right? You buy that position and you just leave it there until expiration. And so that's why these quarterly expirations tend to have the bigger positions. So, you have on the big quarterly expirations, and you add on the 0DT flows and the adjustments, and you end up getting these, very large volumes.
So when we're talking about trading, generally our audience is more of a retail trading audience, and we're in we try to understand what's happening on the greater scheme of things, but we're really trading day trading, right? Where we might be doing some swing trading, but we want to be aware of what is happening during the day that could give us opportunities to trade, or maybe they're I hate to say landmines, they're obstacles to watch out for, and so we want to be careful. So, we're talking about a very specific day. We're talking about the third Friday in June. There's 3 more like it, right? If you want to talk about the magnitude, but really there are 12 more like it. There are 12 third Fridays in every month. So are we to look out for that activity that you witnessed, that you pointed out on the 15th, where there's a big move? Maybe there wasn't any news happening. I can't recall. It was a Friday. It was right before I went on vacation. So my mind's a little blurry.
There wasn't anything really going on.
Yeah, right. So is that something, do we put it in our notebook? Okay, third Friday of the month. Check, it is. Okay, let's look at 9 o'clock or 9:30 or 10 o'clock, this time period for activity that might not be able to be ascribed to any economic news or any kind of external news, and just be aware that there might be some volatility in that 30 to 60 minute time frame.
Yeah, I think that's 100% true. I think as a base case, the way that we look at it is that if the market has a lot of strength into that third Friday of the month, then we look for weakness. If the market is weak into that third Friday of the month, then we look for the market to rally after. So it's a mean reversion trade oftentimes around these options expirations. And there's a size of expiration related to this, how big are the options, positions, et cetera. But you kind of just put in your notebook, hey, the quarterly expirations, so as you mentioned, March, June, September, December, those are really big expirations. They always have a lot of size. So the third Friday of those months. And then again, as you mentioned, the monthly expirations can often have a decent amount of size too. And if you look back, there's a lot of studies on this now. You can see that there is this case for mean reversion around these big options expiration days. And then there's some other anecdotal times you want to watch. I mean, everyone's talking about the Friday trade is this JP Morgan collar roll, and there's a big position at 43.20 that expires on Friday. So a lot of people are talking about, how's that impacting the market? What are the flows around that trade? So if you're sitting there on Friday and you just see whacked out things happening, it's likely because there are these big flows coming in and moving around, and that can shift things. And that's not only just from the options perspective. Obviously, there could be quarterly rebounces on this day as well. So there's a lot of external flow that may make you say, hey, my standard metrics may not work. The things I normally am watching for may not work on those days because there's this kind of like artificial, so to speak, flow coming in, if that frames it the right way.
So I just want to unpack that just a little bit. The JP Morgan collar trade expires this Friday. Is that when you're talking this Friday, you're talking June 30th. June, what is it, 29th or 30th, right?
30th,
June 30th. So that's information that that the market knows. They put that out there, and it gets, is it put out just in general, or is it put out to their clients and then it just kind of gets out in the public?
Well, it's in the prospectus that this big JP Morgan long equity fund puts on this collar trade. So what they do is once a quarter, so it's going to happen on June, they sell a 3% out of the money call, and they use that money to buy a put spread. So it's called a collar again, and that's how they hedge their equity exposure. And so it becomes this focal point, and in particular the last 6 months, it's become this, if you go on a FinTwit, Twitter finance, you just see everyone's talking about this, right? This collar trade. So there's about 45,000 contracts, $100 million, $150 million worth of notional value right now, tied to the 43.20 strike for Friday for the S&P 500. And so, the sort of level one analysis of this is that level is going to draw the market in. I think it's not quite that simple, but the thing you need to know, again, if you're just want to be aware of this, is that trade is going to roll to a new strike, right, to the next quarter. And there's going to be could be a lot of hedging flows. There could be a lot of end of day flows tied to this. There could just be a lot of activity in the market that could really shove things around, right? That could really move things around. I think it's very hard to predict how it's going to be hedged and how that could impact the market. But it's one of those things where you go, hey, if strange things are happening on Friday, there's valid reasons for it, right?
And you mentioned the 3% out of the money calls. That 43.20 represents the 3% out of the money calls when it was put on 3 months ago, correct?
That's exactly right. So the market was substantially, under where we are now.
Right.
If you look back at the history of this trade, it's hard to argue that it's really added a whole lot of value in terms of hedging for the fund itself. The market historically has not reacted all that much to the strike over the last 2 or 3 expirations. It seems like the market's kind of interacted or reacted to this level a little bit. It's kind of splattered all over the news and Twitter again on upcoming on this Friday. So I think, that's part of the reason the market has come down into this 4,300-ish area. I think we're a little bit over that today, the S&P index. We have Powell speaking tomorrow, Thursday the 29th. I think he talks at like 2 in the morning because he's doing something in Spain. So, that can move the market a little bit. And then not only do you have the JP Morgan roll happening on Friday, Goldman says it's one of the larger equity pension fund rebalances. I don't know if it's strictly pension funds, but there's a big equity rebalance that should take place in that quarter. So there's just a lot going on that Friday, and so traders really do need to be aware of that.
Right, and I think Chair Powell speaks tomorrow too at 9:30 a.m. So, he's doing a little bit of double duty this week with his speaking events. But you're right, it's Thursday. It's 2:30 in the morning. He's over in Europe, and it's their open, and it's closer to the expiration than tomorrow, so could have a little bit more impact.
And I think odds are, if you look at what the options market's pricing in for these events, I mean, it's not much. There's not real much concern around, these events. I mean, the VIX is, whatever is 13 or 14 right now. I haven't seen it in the last hour. But risk is perceived as very low right now in the market. And to that point, we've seen the value of calls rise so much relative to the value of puts over the last month that I think the other reason that a lot of the market has been weak here is that the call values just got too high, right? You couldn't justify paying that level for call prices any longer. And that needed to cool off quite a bit and just kind of mean revert. And that goes not only for, the NVIDIAs and Teslas of the world, but you could see in IWM, for example, massive expensive call positions and all that really needed to deflate and cool down and come back to average. And now it's interesting because we've seen that, right? We've seen a lot of mean reversion in call prices. Volatility's kind of come down here as the market has come down. And we're at this really interesting turning point in the market where our view is we see support at 4,300 or 4,320, kind of in that general area here into Friday. The market is pricing in very little movement. So if you look at what the market is pricing in, it's pricing in 60, 70 basis points, and 1 standard deviation movement on every trading day. So that's really not very much. And then Friday we got, Powell's going to come and say what he says. We got this JP Morgan trade. We got this pension fund rebalancing. There's a lot of reasons to think that things could really start to move again. And I don't have necessarily a directional view on that. Just the idea that volatility should pick up a little bit more on Thursday and Friday. So, if you're a retail trader and you're playing right now, you're probably trying to maybe scalp, 5 or 10 handles at most in the S&P, for example. You may want to position for larger moves, right? As you hit Friday, where, 40 points or 1% moves could become a little more likely.
And with that with the information that you just said about what's coming out with the speaker and the position coming off and then the rebalancing, would somebody who might be interested in trading VIX futures look at that and say, I might be bullish on the VIX, right? I might think we're low now and then it might, at least in a short term.
Yeah.
Right.
I think that's true. I mean, if we break the 4,300 level in the S&P in particular to the downside, then I think that long VIX futures trade looks really good. If we hold that 4,300 level, that is where I think it could get a little more murky in terms of, is vol really going to react? Because the way that you would measure this on a baseline is you would look at what we call realized volatility or historical volatility. And all that does is say, how much has the market, S&P speaking, how much has it been moving over the last 30 days? And if you look at that, it's been moving with a realized volatility of like 11 to 12, right? And 12%. And so that tells us that that should be the baseline for where forward-looking volatility should be, right? So what should the VIX be at right now? Well, at its lowest, you would think around 11 or 12, right? And if you look at the S&P equivalent volatility looking forward, it's basically 11 or 12. So the point here is that the market is not pricing in more volatility in the future than what we've had over the last 30 days. It wouldn't take much to move the market more than 60 basis points, 70 basis points, right? I don't. That's not asking for a lot, with some of these events coming forward. So the general idea here is that, when should you expect volatility, or when should that volatility pick up? Is there a catalyst? And here we have a couple of catalysts in terms of the flows that are coming into the markets. I don't think Powell is, set to really say anything. I think as a base case, those are usually, nothing done type events, right? When Powell's speaking, but it adds a little bit of, something to the mix possibly. I think the bigger deal here is this catalyst that could really, trigger things to move a little bit more. One of the other things is that on this topic is that if you look at the VIX is very low and volatility in the S&P is very low, but that single stock volatility is very high. And that matters to futures traders because, NVIDIA, Apple, Google, Microsoft, et cetera, those are the largest components of the S&P 500. Those all got squeezed, right? Again, back to this breath issue of, hey, the market, the S&P is getting dragged higher, the NASDAQ's getting dragged higher by, 10 different stocks, basically. There's a lot of volatility in those stocks over the last 6 weeks, right? There's a ton of volatility in those names. And so, there's been some discussion about the idea that there's a big trade out there, or, it's called a dispersion trade. But basically what you do is you sell S&P volatility and buy single stock volatility. It's getting complicated for purposes of this conversation, but the point is that there is volatility happening in other areas of the equity space, and that has gotten to kind of record levels, depending on exactly how you look at it. In other words, the spread between how much single stocks is moving versus the underlying index has gotten very stretched. And so that's things mean revert, right? And that's just another reason why, hey, it wouldn't take much just to get, again, this doesn't have to be a 10% drop or a 5% drop. It could be a 3% rally in the S&P, The sort of first order effect here is volatility. And I think if we break 4,300, that's a sign that that's going to manifest to the downside. But if we hold 4,300 after this roll, then, we could easily see, I think, a move back into the 4,400 to 4,500 range within a couple of days, certainly the first week but by next week.
Awesome. So we've been talking a lot about the S&P 500. Can we take a look at NASDAQ? Because you did mention some big stocks that are more tech stocks, and I'm just curious, understanding that NASDAQ, you tell me, JP Morgan have that collar on in NASDAQ, or is it just E-mini S&P, and NASDAQ has different forces going on with work indicating maybe different levels as well?
Yeah, and NASDAQ has different forces going on. I think there's a call overriding strategy that may have a decent amount of open interest to it, but it doesn't have anything like this collar trade. And that collar trade, it matters in and around when it's going to expire. You could argue that it has a little bit of an effect, if the market rallies sharply to some extent, or is it in and around the call strike like we are now. But, by and large, the effect of that trade is kind of, I think, overstated in a lot of ways. When we look at the NASDAQ, what we typically look at is the open interest or the options positioning in the QQQ ETF, and that's because as a notional value, those options represent a much larger complex, so to speak, than the NDX index options. And so we're typically analyzing the Qs as they're linked to the NASDAQ futures, as they're linked through that through tracking the same benchmark essentially. And they both react to tech stocks and the like. And so what you've seen with the Qs is it's had an incredible performance, into June OPEX. It's down, I think it's up 1% today, but it was down 4% as of this morning versus the S&P that was down 2.5%. It has much higher relative volatility just as a base case, but certainly as a result of the fact that all these tech stocks are really getting bid up, right? And then there was such a chase there. And so when we look at the NASDAQ, we have this really big options level at 360 in the Qs, and that should be a kind of a support level, or this area of where the options hedging flow should really unlock. And then there's a fair amount of open space above that up into the 370 area. So our base case now, as we've been saying in our subscriber notes, was that we actually think that the tech space is now more attractive from an options perspective to reroute to stage sort of a second rally here. And that's based off this idea that the call options were very expensive. The volumes were kind of, got over their skis. All that has deflated, right? Those values have come back in line. A lot of these stocks have kind of rebased, I would say, come back into where a lot of big options positions are. And that may make them more attractive now that they've kind of, had a little bit of that mean reversion and cooled off a little bit.
And that could explain a little bit why we might see different performance in the E-mini S&P and the NASDAQ at the end of the week. As we've seen, it just seems like every day there's one clear winner, one clear loser, and then the other two are kind of in the middle, or maybe two are clear winners and the other two are, they might be up, but they might not be up as much. Right now, Russell leading the way today, NASDAQ not too far behind, and then you've got the E-mini S&P and the Dow, kind of in the rear view. So, but all positive, right? Market's up today.
Yeah, and I think you can make a case right now that JP Morgan position is sitting on the market a little bit. If you look at the way that option traders are pricing in, the probability of movements in the S&P, that 4320 strike leaves a fingerprint in the market, right? And you can make an argument that, the decay of that position weighs on the S&P a little bit. And so, this is one of those interesting times where you go, well, NASDAQ is not as tied to that, and neither is the Russell, right? So, there is this kind of interesting, maybe you see some of the effects, right, of this option positioning in the relative performance of these indexes. And the other thing is, the NASDAQ had incredible performance. It outperformed everything. These calls got very expensive. And then I think a lot of traders turned their attention to, hey, yes, AI is a story that has kind of like run its course, at least in the short term. These positions have gotten too expensive. And then it was like the attack vector suddenly shifted to the IWM. And we had, again, those record IWM call volumes. And you saw, the Carvanas of the world and all these kind of meme stocks, right, start to explode higher as traders sort of said, well, let's play this index so that it can catch up, right? There's maybe more relative value in that space. And so, both of those sectors, so to speak, or indices, they did cool off, they kind of rebased, and, it is now more available to rally, right? We went from like extremely expensive to fairly valued, I think, from an options perspective. Just because we're fair value doesn't mean we have to rally, but it does, that's why it's such an interesting point in the market here where you go, we're not overbought anymore through our lens. Doesn't mean we have to rally, but we're not overbought anymore.
Okay, interesting. One thing that we've talked about before on Traders Workshop is the trading day after options expiration. Right. And sometimes we think about, options expiration, the market might move real quick or might move. And we look and maybe it doesn't look so much like a big moving day or, a big move on the day of that options expiration. But sometimes we see it the day before. But I think in the day after, when you have to rehedge and not you, but some of these institutions have to rehedge their positions, that's options expiration. Do we see the same kind of thing when we end a quarter, like because of the rebalancing of pensions or portfolios, or in the case of the E-mini, this position that JP Morgan took? Do we see maybe not as large of an effect, but do we see the effect of putting on these new options strategies, putting on these new positions in other managers' portfolios rather? Could there be some volatility, let's say Monday?
I think it's a great question, number one. In respect to the pension fund rebalancing, the like, I don't have a great, I don't do any study. It's kind of, I'm unaware of anything, really to say about that. In terms of the quarter end expiration, so we're talking about the 30th, of the month, not 6/16, the June expiration that just passed. There's a great deal of effort made by the dealer and the brokers handling, I think, that collar trade to be what we call like market neutral, I guess, or delta neutral, right? So they can use like zero DT options and EFPs and all sorts of trades like that to sort of try to mitigate the impact of that trade. And I think by the following Monday, it's hard to make a case, and I haven't really seen anything convincing in any data that says like, hey, Monday, is moved by this one single trade. On a single stock basis, 6:30 expiration doesn't really mean anything. Then to the NASDAQ, to the IWM, doesn't really mean anything from an options perspective. From a rebalance perspective, in terms of equity rebalancing, again, I'm not sure about that. But just in terms of that collar trade and the June OPEX, I don't think it's anything where you say, hey, I can trade on Monday in this specific way, because of the hedging flows from this collar. Now, I think if you were able to say, definitively that the hedging of that collar trade moved the market 2% up or down, and you want to play mean reversion off of that, maybe. But again, I think it's hard to pull that out given a lot of the other things that are taking place. And the other thing is that, the way that they used to hedge that trade, the fingerprints you could find, shifted over the last several expirations. So the way you'd be able to go, hey, this looks like what they're doing to hedge that collar trade, that just moved futures down, whatever, 20 handles. I can play that now that I know that their hedge is done. The way they've traded it seems to have changed a little bit. And I think they'll continue to change that because of the fact that everyone's so aware that the trade is taking place.
Do you think, is it due to the zero DTE being available to them now, or is it more of their being a little more strategic with how they actually put on the trade, like you would as a futures trader at an institution? You have a large position, you don't throw it all in the market at once, right? A good trader will space that out at the command or at the wishes of the person who said, hey, you've got to put on this position, but you've got half hour to do it, an hour to do it, a day to do it.
Yeah. As far as the zero DT point, you bring up a great point. However, there's always a contract that expires on 6:30 expiration. It's been that way for quite a while. So they have a zero DT available and they've had a zero DT available, and sometimes they would use that. Typically they would sell what's called a deep in the money call as sort of a hedge, and you could see that sort of trade. And then in respect to the other thing, anytime you are a big fund or have a big trade going on and everyone's aware of it, other traders want to use that, information against you, right? This is like Wolf of Wall Street, or what's the other one with Michael Douglas and
Wall Street.
Wall Street, thank you. Just Wall Street. If I know Tom is going to buy $1 million of Apple and I can push it against them for some reason, I'm going to do that, right? Or I'm going to squeeze you out of your position, or I'm going to do, you have a disadvantage if with that information leakage. So I think they can do one of two things. One, they don't want to give idea of what they're doing because traders could use it against them or push against them, make it more difficult to hedge or more expensive or run, position against them. And that's just bad for the client, right? It's bad for their own book and bad for the client. And number two, I just think that everyone is expecting one thing to happen. And so it's sort of like in poker or whatever, you can be like, hey, look over there. And then you go the other way kind of thing, right? So maybe they can even, gain a little bit of edge from doing that. So they're incentivized, and I think they have, you could argue, kind of a fiduciary duty to adjust how they're hedging. Now the client can't adjust, right? The client still needs this position, it's in their perspective, but the broker in theory can do whatever they want to make sure that the client gets their fill correctly at the end of the day. And there's a lot of funny things you could do with this, such that at 4:15 or 4:14, you could just print the client's contracts and they're happy, right?
Right.
Where the client would get upset is if you move the market against them and you cost them a whole bunch of money, and the broker certainly doesn't want to move the market against themselves, right? So it is a dance, and it's sort of a poker exercise, I guess, or a psyop exercise, or whatever you want to call it.
Well, and I think that's something as a day trader or as a retail trader, a swing trader, you don't experience, right? I'm as a day trader, I'm not going to put in a trade that's going to move the market, right? If anything, I'm going to get moved. My order is going to get moved. But there are real trades out there that are so large that it's not just about clicking a price on a chart. It's a lot more strategy to that, and that's fascinating. In your experience at the institutions, you saw it firsthand.
Yeah, and it's true. It's true in the equity space, particularly when you get into smaller, or mid cap stocks, right, where the liquidity is not quite as great. But it's even more true in the options space, where the notional value per contract is a lot larger, the bid ask is wider. In the S&P, you have to oftentimes call up a broker. You're dealing with other people. People know what you're doing. There's multiple counterparties a lot of times. So if I trade with you, I might mess up your colleague Jim if he also is trying to get on the trade. So there's a lot more aspects to that. And then not only that, you have risk as the dealer, but you also have the client also has risk. So you're also kind of answering to somebody else. And so in this case, it's not necessarily like, hey, can they get the liquidity? They'll get the liquidity. It's just how do they hedge it the appropriate way? How do they try to mitigate the impact of that trade? And to your point, for us in retail land, this is never a thought, right? You may miss a fill because you just put out a bad limit price, so to speak. But you never have, or rarely have, an issue where it's like, hey, I was trying to get filled on 10 and I only got filled on 3 or something, right. Because no one's interested in trading with me. So you're quite right in that respect.
So we talked about E-mini S&P, we talked about NASDAQ. Any other markets that you cover? We don't have to go over them now, but is it limited? Is SpotGamma limited to stock index futures in the futures world, pretty much?
Yeah, we focus on equities and the equity indices and equity futures, as well as the volatility complex. And we've looked at commodities and crypto and things like that. And the main reason that we've held off there is because there's a lot of assumptions that we can make for our modeling purposes in the equity space, because that's where we're born and bred. We understand that space. And then when you start to get into commodities, there's other factors, right? There's other flows going on there that we don't necessarily understand as well, right? They're different markets. And so, we've just avoided, going into that space. And that's not to say we won't change that at some point or may offer some modified data or something like that. But, I found, like, if you just don't fully understand, what it is, or even have like half of an idea of what it, you're writing about, then it's probably just best to avoid it. So, I think with most equity things, I could take a swing, or at least I know what I don't know, and can say so. But if you're going to have me look at oil or corn or wheat or whatever, I don't have a whole lot to offer you.
Right, and that shows that your analysis is not just looking at a chart or looking at, there's a blend of fundamentals and I won't say technicals, but data analysis, right? And
yeah.
It's a little more, like I said, than just looking at a chart. So we're running up against time. Where can people find you? What's the best place to reach out to you if they want to continue the conversation or have questions for you?
Thanks for that opportunity. If you go to spotgamma.com, you can hit subscribe now. You get a free 7-day trial. You can check out you get our daily notes. We have a real-time options product called Hero. And what that shows you is in real time how these options flows are impacting the market. So if you want to watch 0 DTE options, for example, you can do so. You can see that here. And so what we can see on the day, just to give an example, this white line is the S&P 500 options, S&P 500 index. The purple line is the hedging impact of all of the options taking place. And so as you mentioned before, the market's very strong. And I can tell you that this means that people are buying SPX calls, Spider calls, and E-mini futures calls. And that is really a very large number, $4 billion over the day so far. And that's helping to make the market rally. So if these call flows shut off, then we could get some mean reversion. But until those call flows shut off on the day, you're probably best to not short, I would say. But that's just a guess. Please don't take that trading advice.
Exactly. Jim did a great job with the disclaimer at the beginning of the show. But as we always like to say, we're not giving you trading advice. Don't take it as trading advice, but information. That Brent is certainly the expert on options, all things options in the equity market. So appreciate that, and hope you, as the viewers, can go search out SpotGamma and Brent and see what else there is to offer there.
Yeah, thanks so much, and had a great time talking to you. Appreciate it.
No, pleasure's all mine, Brent. I learned something new every time we talk, and it's great to see you, and we'll definitely be back here, hopefully, real soon. But I want to thank the viewers for coming and watching, and we will finish the day, Jim Cagnina, with bars closing as he does on Tuesdays. We're kind of back into a normal schedule. I don't know if you know this, Brent. Jim went on vacation, then I went on vacation, so we're kind of finding our rhythm back again. But it's great to be back and great to see you as always. And so I want to wish everybody, in the meantime, have a great trading day, and we'll see you at bars closing.